There is a strange and seductive lie at the heart of the modern financial world. It's whispered in the frantic chyrons of cable news, it's shouted by the manic hosts of stock-picking shows, and it's embedded in the very design of the trading app on your phone, with its flashing green and red lights that mimic the dopamine rush of a casino slot machine. The lie is this: that activity equals progress, that motion equals results, that in the great and chaotic arena of the stock market, the person who is busiest, the person who trades the most, the one who reacts fastest to every headline and every tweet, is the one who will ultimately win. Your broker certainly hopes you believe it. The financial media industry depends on your belief in it. But it is a lie. And this lie is costing millions of retail investors their shot at genuine, life-changing financial freedom. The truth, as is so often the case, is quieter, less exciting, and profoundly counterintuitive. The truth is that the stock market is a device for transferring money from the active to the patient. For over 60 years, a man in Omaha, Nebraska has been running one of the most successful financial operations in human history, not by being the busiest, but by being the most disciplined in his inactivity. Warren Buffett's superpower is not his ability to predict the next hot stock or to time the market's every gyration. It is his almost superhuman capacity for strategic patience. It is his understanding that after you have done the hard work of identifying a wonderful business and buying it at a fair price, the most profitable and strategically sound action you can take, most of the time, is to do absolutely nothing at all. To sit on your hands. To go to a movie, read a book, play bridge, and let the magnificent compounding engine of a great American enterprise do the heavy lifting for you. This isn't laziness. It's a form of financial discipline so potent and so rare that it has become a kind of arbitrage opportunity in a world addicted to motion. We are going to deconstruct this principle piece by piece to build for you a mental framework that can protect you from the single greatest destroyer of wealth for the average investor: the compulsion to constantly transact. We will explore the deep-seated psychological biases that drive this destructive behavior. We will lay out the practical mental models Buffett uses to overcome them, and we will quantify the staggering financial cost of ignoring this timeless wisdom. This is not just a lesson in long-term investing. It is a masterclass in investor psychology, a blueprint for a stock market strategy designed not to enrich your broker, but to secure your own capital growth and put you on the path to true wealth management. Our journey begins with the foundational enemy, the ghost in the machine of our own minds that screams at us to act, even when action is the surest path to ruin. It is a cognitive trap known as the fallacy of action bias. In the mid-1970s, the American economy was in turmoil. The optimism of the 60s had curdled into the stagflation of the 70s. An oil crisis, a political scandal that reached the White House, and a brutal bear market had soured the nation's mood. Between January of 1973 and December of 1974, the stock market was cleaved in half, a gut-wrenching 50% decline that vaporized fortunes and shattered the confidence of an entire generation of investors. It was in this environment of profound pessimism and fear in 1973 that Warren Buffett began to take a very serious interest in a newspaper company, the Washington Post. The Post was a storied institution, a pillar of American journalism, led by the formidable Katharine Graham. It had recently published the Pentagon Papers and was in the midst of breaking the Watergate scandal, investigative reporting that would ultimately lead to the resignation of a president. From the outside, it was a business at the height of its power and prestige, but on Wall Street it was treated like toxic waste. The company's stock had been hammered along with the rest of the market. Its valuation had fallen to a mere $80 million. Buffett, poring over the financials in his quiet Omaha office, saw something entirely different. He saw a business with a powerful local monopoly, a dominant franchise in a major American city. He saw a brand that commanded immense respect and pricing power. He calculated that you could sell off the company's television stations and other assets and essentially get the newspaper, the crown jewel, for free. In his mind, the entire enterprise was worth at least $400 million, maybe $500 million. And it was being offered to him for 80. This was the very definition of a wonderful business on sale. So he began buying. Quietly, methodically, he accumulated shares until Berkshire Hathaway owned more than 10% of the company, an investment of just under $11 million. And then, the true test of an investor's mettle began. The market didn't immediately recognize his genius. The bear market wasn't over. The stock didn't rocket back up. In fact, it kept going down. For a time, Buffett's $11 million investment was worth closer to $8 million. Imagine the pressure. The greatest investing mind of his generation, making a huge, concentrated bet and immediately finding himself millions of dollars in the red. The entire financial world was screaming, "Sell!" The headlines were bleak. The talking heads were predicting a new Great Depression. Every instinct, every fiber of a normal person's being would be to act, to cut your losses, to sell the position and wait for more clarity, to do something to stop the pain. Warren Buffett did nothing. He sat on his hands. He read the Post's annual report. He saw that the business itself was still performing, that its competitive position was still intact, that its intrinsic value was still growing. The price flashing on the stock ticker was an illusion, a temporary manic-depressive hallucination of the market. The business was the reality. He held. He held through the fear of the mid-70s. He held through the booming 80s. He held through the crash of 1987. He held through the dot-com bubble of the 90s. For over 30 years he was a silent, patient partner in the business. That initial $10.6 million investment grew, over time, into a holding worth more than $1 billion. It was a 100-fold return, a testament not to frenetic trading, but to a profound and profitable stillness. It was the ultimate victory over the fallacy of action bias. This urge to act, the one Buffett so masterfully resisted, is not a personal failing. It is a deep and ancient feature of our cerebral hardware. Psychologists call it action bias, our innate tendency to favor action over inaction, even when there is no rational evidence that action will lead to a better outcome. In many areas of life, this bias serves us well. When our ancestors on the savannah heard a rustle in the grass, it was far better to run first and ask questions later. The one who paused to analyze the situation was more likely to become lunch. Action meant survival. This fight-or-flight response is embedded in our amygdala, the primitive part of our brain that processes fear and threats. The problem is that the stock market is one of the few arenas in modern life where this ancient programming is not just unhelpful but actively destructive. A plummeting stock price on your screen is the modern equivalent of that rustle in the grass. It triggers the same primal fear, the same flood of cortisol, the same desperate scream from your amygdala to do something. Sell, buy, rebalance, anything to make the feeling of uncertainty go away. This is compounded by another cognitive trap, the illusion of control. We believe, falsely, that by taking action, we are exerting control over an unpredictable situation. Clicking the sell button feels like grabbing the steering wheel of a car that's skidding on ice. It provides a momentary sense of agency, even if the action itself, selling a great asset at a low price, is the worst possible thing you could do. The entire financial industry is a monument built to exploit this psychological flaw. The constant stream of breaking news, the second-by-second stock charts, the endless commentary urging you to buy this and sell that, it's all designed to stimulate your action bias. It creates an environment of perpetual urgency, convincing you that if you just sit still, you're falling behind. They know that a patient, buy-and-hold investor is their worst customer. An active trader, on the other hand, is a goldmine of trading fees, commissions, and spreads. They profit from your activity, regardless of whether you do. Buffett understands this on a fundamental level. He has deliberately structured his life and his business to insulate himself from these triggers. He works in Omaha, far from the frenetic noise of Wall Street. He doesn't have a stock ticker in his office. He famously says he prefers to read annual reports and business histories, focusing on the long-term reality of the business, not the short-term noise of the market. He is overriding his own primal wiring and replacing it with a cold, rational, and supremely profitable logic. So how can we, as retail investors who are constantly bombarded with these triggers, begin to build a similar defense? We need a practical instruction manual, a mental model that translates this theory into a concrete process. Let's call it the inaction protocol. It's a set of rules you establish for yourself during times of calm, to protect you from your own irrationality during times of storm. The first step of the protocol is to create a pre-commitment contract for every single stock you purchase. Before you click the buy button, you take out a piece of paper or open a document, and you write down, in clear, unambiguous language, the specific business-related reasons you are buying this company. You also write down the only ties conditions under which you will sell it. These conditions cannot be based on the stock price. They must be based on the fundamentals of the business. For example, I will sell my shares in Company X if its primary competitive advantage is eroded by a new technology. Or, I will sell if a new management team takes over and begins to destroy shareholder value through reckless acquisitions. Or, I will sell if I find a demonstrably superior investment opportunity that offers a much higher return for a similar level of risk. By writing this down beforehand, you are making a contract with your future, more emotional self. When the market is crashing and your heart is pounding, you don't have to think. You simply refer to your contract. Have any of your sell conditions been met? If the answer is no, then the only permissible action is to do nothing. The second step is the 48-hour rule. You are forbidden from making any buy or sell decision within 48 hours of a major market-moving news event related to one of your holdings. This applies to earnings announcements, news of a lawsuit, a sudden analyst downgrade, or a broad market panic. This mandatory cooling-off period acts as a circuit breaker for your amygdala. It prevents you from rage selling after a bad earnings report or panic selling during a flash crash. It forces you to let the initial emotional wave pass, to let the dust settle, and to reevaluate the situation with a clearer mind, referring back to your pre-commitment contract. The third and final step is to implement an activity budget. Most people budget their money. A wise investor budgets their actions. Decide at the beginning of each year that you will allow yourself a maximum number of transactions, say 4, 2 buys and 2 sells for the entire year. This scarcity forces you to think like a professional wealth manager, not a gambler. It elevates the importance of each decision. You are no longer looking for a quick trade. You are looking for a commitment. You are forced to focus only on your highest conviction ideas, which is the very essence of a successful long-term investing strategy. This protocol is not about being passive in your research. It's about being passive in your transactions. It is a system for enforcing financial discipline and short-circuiting the destructive pull of action bias. To truly appreciate the power of this protocol, we must look at its opposite, the path traveled by the 99% of investors who are perpetually guided by their emotions. This is the path of the antithesis, the path of frenetic, wealth-destroying activity. The average retail investor behaves like a terrified passenger in a turbulent airplane, constantly unbuckling their seatbelt to run up and down the aisle, convinced their movement will somehow stabilize the craft. They wake up and the first thing they do is check their portfolio, their mood for the day, set by a sea of red or green. They watch a financial news segment where a charismatic expert pounds the table about a new tech stock, and they immediately feel a surge of FOMO, the fear of missing out. They log into their account and buy a small position without reading the annual report, without understanding the business model, without a pre-commitment contract. They are chasing a story. A few weeks later, the market dips. That same stock is down 15%. The news is filled with talk of recession. The same expert is now silent or has moved on to a new, unbeatable idea. The investor, who has no foundational belief in the business itself, feels the icy grip of panic. Their only signal is the price, and the price is telling them they made a terrible mistake, so they sell, locking in a 15% loss, vowing to be more careful next time. Then, the market recovers. A different sector gets hot. The cycle repeats. This investor is not investing. They are gambling. They are whipsawed by greed and fear, buying high in moments of euphoria and selling low in moments of despair. They are paying constant trading fees that bleed their account, and with every sale, they are potentially generating short-term capital gains, which are taxed at a much higher rate than long-term gains. They are a perpetual motion machine for their broker, generating a steady stream of commissions, but their own account value goes sideways or down over time. Think of the great manias of the past. In 1999, people who had never invested before were quitting their jobs to become day traders, buying any company with .com in its name, convinced it was a new paradigm. They were hyperactive, making dozens of trades a day. When the bubble burst, they were annihilated. Their activity didn't give them control, it just ensured they were fully exposed to the catastrophe. The path of the 99% is a treadmill of high stress, high fees, and high taxes, leading directly to mediocrity or ruin. It is the direct consequence of surrendering your rational mind to the primitive, powerful, and profoundly misleading urge to always be doing something. The financial impact of choosing strategic inaction over hyperactivity is not small or incremental. It is a monumental force that over an investing lifetime can be the sole difference between a comfortable retirement and a vast, multi-generational fortune. Let's make this tangible. Imagine two investors, both starting with $100,000 and both achieving the same raw 10% annual return from their underlying investments over a 30-year period. Investor A follows the inaction protocol. They buy a portfolio of high-quality businesses or a low-cost index fund, and they do not touch it. Their only costs are the minuscule management fee of the index fund, let's say 0.1%. For 30 years, they let their capital growth proceed uninterrupted. Investor B is the active trader, the follower of the path of the 99%. They trade frequently, trying to time the market and chase hot trends. Between trading fees, bid-ask spreads, and the higher taxes they pay on short-term gains, their flurry of activity creates an annual drag on their returns of just 1.5%. It sounds trivial, 1.5%, but this is the tyranny of compounding costs. After 30 years, Investor A, the patient one, would see their initial $100,000 grow to approximately $1,665,000. A life-changing sum. Investor B, the active one, starts from the same place. But that tiny 1.5% annual drag acts like a constant friction on their compounding engine. Their final portfolio value would be just $926,000. That is a difference of over $739,000. The active investor gave up nearly half of their potential fortune, not because their stock picks were worse, but simply because of the friction of their activity. They enriched their broker and the government to the tune of $750,000. This isn't a hypothetical. This is the mathematical reality for millions of retail investors. The direct financial connection is undeniable. Every unnecessary transaction is a leak in the boat of your wealth. Strategic patience plugs those leaks, allowing your portfolio to fill to its absolute maximum capacity. It is the purest form of financial discipline, and it is the bedrock of Buffett's entire philosophy. The first step to emulating this philosophy is to stop thinking like a stock trader and start thinking like a business owner. This is the second great pillar of strategic inaction, viewing your investments not as flashing ticker symbols but as partnerships in wonderful businesses. This mental shift changes everything. It provides the intellectual and emotional foundation necessary to sit still through the market's inevitable storms. There is no story that illustrates this principle more perfectly than Buffett's acquisition of See's Candies in 1972. At the time, Berkshire Hathaway was still primarily a textile company, Buffett and his partner Charlie Munger were looking for high-quality businesses to buy with the profits from their insurance operations. Through a contact, they were introduced to the C family, who were looking to sell their beloved California-based candy company. C's was not a sexy, high-growth technology firm. It was, in many ways, a boring business. They made old-fashioned chocolates and sold them in their own retail stores. But Buffett and Munger saw something extraordinary. They saw a business with a fanatical customer base. People in California had grown up with C's. Giving a box of C's at Christmas or Valentine's Day was a tradition. This brand loyalty gave the company tremendous pricing power. Every year they could raise the price of their chocolates a little bit, and customers would happily pay it, because the emotional connection to the product was so strong. It was a business with a deep and durable competitive advantage, a moat, as Buffett would later call it. The C family was asking for $30 million. Buffett, after his initial analysis, thought it was worth no more than $25 million. He made his offer, and the family initially rejected it. For a moment it seemed the deal would fall through. But Munger, in a moment of characteristic wisdom, told Buffett, "You're not going to buy a business like this for $25 million. You have to pay up for quality." Buffett relented. They bought the business for $25 million, and it became one of the most important acquisitions in Berkshire's history. Not because of its size, but because of the lesson it taught them. They didn't buy C's to flip it a few years later. They bought it to own it, forever. They became partners with the business. And what a partner it turned out to be. Over the years, C's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, and it did so while requiring very little additional capital investment. It was a cash-generating machine. The profits from selling chocolates in California were sent back to Omaha, where Buffett and Munger then used that money to buy other wonderful businesses, like Coca-Cola or the BNSF Railway. The key insight is this: once they bought C's, they let it do its work. They didn't try to time the candy market. They didn't sell their stake when there was a bad Christmas season. They trusted the management they had in place, they trusted the power of the brand, and they simply sat back and collected the cash. They were patient owners, not active traders. This mindset, that you are buying a piece of an actual living, breathing business, is the ultimate antidote to the panicked need to transact based on squiggles on a chart. If you owned a successful local restaurant that was beloved by the community and generated steady profits, would you sell it because a commentator on television said the restaurant sector was facing headwinds? Of course not. You would look at your own cash register. You would talk to your customers. You would trust the reality of your business, not the chatter of the market. Applying this exact same logic to your stock portfolio is the secret to developing Buffett-like patience. The psychological principle that underpins this powerful mental shift is a combination of two potent cognitive biases, the endowment effect and ownership bias. The endowment effect, first identified by behavioral economists like Richard Thaler, describes our tendency to value something more highly simply because we own it. In experiments, people who are given a coffee mug will demand a much higher price to sell it than people who are offered the chance to buy the exact same mug. Ownership imbues an object with a subjective value that goes beyond its market price. When you view a stock as just a ticker, a temporary holding in your account, the endowment effect is weak. It's easy to sell. But when you reframe it in your mind, when you tell yourself, "I am a part owner of Apple. I own a piece of the creative genius of their engineering teams, a sliver of their global brand, a claim on their future profits," the endowment effect kicks in with full force. You are no longer just selling a stock. You are parting with a piece of a magnificent enterprise. This immediately raises the bar for a sell decision. Ownership bias is a related concept. It's our natural inclination to view our own assets and our own decisions in a more positive light. This can be dangerous if it leads to overconfidence, but when applied to long-term investing, it can be a powerful force for patience. When you see yourself as an owner, you are more likely to give the business the benefit of the doubt during tough times. You are more likely to focus on its long-term strengths rather than its short-term stock price weakness. You become a supporter of the company, a partner, rather than a detached speculator. This is the exact opposite of the gambler's mindset that dominates the world of day trading. A day trader has no loyalty to any company. They are purely mercenary, trying to scalp a few cents of profit from fleeting price movements. They have no sense of ownership. Their relationship with a stock is transient and meaningless. The long-term investor, the business owner, is playing an entirely different game. Their relationship is one of commitment. They have done the hard work of analysis up front, and their decision to do nothing is not a passive act. It is an active and continuous vote of confidence in the underlying business they have chosen to partner with. This psychological reframing from renting a stock to owning a business is the key to unlocking the emotional fortitude required for a buy-and-hold strategy. To make this actionable, you need a system for identifying the kinds of businesses that are worthy of this long-term partnership. You need a blueprint, a checklist that helps you separate the truly wonderful, durable enterprises from the fleeting, speculative story stocks. Let's call it the Wonderful Business Checklist, a practical guide inspired by the mental models of Buffett and Munger. The first and most important item on the checklist is to identify a durable competitive advantage. This is the moat that protects the business's profits from the relentless siege of competition. A moat can come in several forms. It could be a powerful brand, like Coca-Cola's, that creates an automatic preference in the minds of consumers. It could be a network effect, like Facebook's or Visa's, where the service becomes more valuable as more people use it, making it nearly impossible for a competitor to displace it. It could be high switching costs, like those for a company that provides critical software to large corporations. The pain and expense of switching to a new system is so great that customers are locked in. Or it could be a low-cost advantage, like Geico's or Costco's, that allows them to consistently underprice their rivals. Before you invest, you must be able to clearly articulate, in a single sentence, what the company's moat is and why it will endure for decades. If you can't, it goes into the too hard pile. The second item on the checklist is to assess the integrity and talent of the management team. Are the executives running the company for their own benefit or for the benefit of the shareholders? Read their annual letters to shareholders. Do they speak candidly about their mistakes, or do they only highlight their successes? Look at their compensation. Is it tied to long-term performance metrics like return on equity, or is it based on short-term stock price movements? You are looking for managers who think and act like owners, who are passionate about the business, and who allocate capital rationally and effectively. You would never go into business with someone you don't trust, and the same standard must apply to the management teams of the companies you invest in. The third item is to understand the long-term economics of the business. Does it have pricing power? Can it raise prices without losing customers, like See's Candies? Does it require huge, continuous capital expenditures just to stay in business? Or is it a capital-light model that gushes free cash flow? A business that constantly needs to build new factories or upgrade expensive equipment may not have much cash left over for its owners. You're looking for businesses with high returns on invested capital and a proven history of generating more cash than they consume. The final item on the checklist is to buy it at a fair price. Notice the wording, a churn time halved the rice, not a cheap price. Munger's great insight was that it is far better to buy a wonderful business at a fair price than a fair business at a wonderful price. You don't have to get the absolute bottom. Your goal is not to be a brilliant market timer. Your goal is to become a partner in an excellent enterprise at a price that makes long-term sense. By rigorously applying this four-part checklist, you filter out 99% of the investment universe. The few companies that pass through this filter are the ones worthy of your long-term capital and, more importantly, your long-term patience. Making the decision to do nothing becomes easy when you have unshakable conviction in the quality of what you own. The antithesis to this disciplined approach is the seductive and ultimately ruinous path of chasing story stocks and speculative manias. This is the domain of the 99%, where the fundamentals of business are ignored in favor of exciting narratives and the promise of quick, effortless wealth. A story stock is a company, often in a hot sector like technology or biotechnology, that has a compelling story but little to no actual earnings or proven business model. The investment thesis is based not on current cash flows, but on a grand vision of the future. This company will cure cancer, this one will revolutionize transportation, this one will build the metaverse. Because there are no fundamentals to anchor the valuation, the only thing that matters is the story and the stock's price momentum. People buy because the price is going up, which makes the price go up further, attracting more buyers in a self-reinforcing feedback loop. This is the very essence of a speculative bubble. The investor on this path has no checklist. Their research consists of reading enthusiastic articles, watching YouTube videos, or participating in hyped-up social media discussions. They don't understand the company's financial statements because, in many cases, there's nothing to understand but mounting losses. They can't identify a durable competitive advantage because the company hasn't even proven it has a viable product yet. Their conviction is not in the business but in the crowd. The GameStop saga of 2021 was a perfect, albeit extreme, example of this psychology at work. A large group of retail investors connected by social media decided to buy shares of a struggling video game retailer to force a, quote, short squeeze on hedge funds. The story was compelling. A David versus Goliath battle, a chance to get rich quick while punishing the Wall Street establishment. For a brief period, it worked spectacularly. The stock price soared to absurd levels, but the story had no connection to the underlying reality of the business, which was still a struggling brick-and-mortar retailer in a world moving online. The people who bought at the top, lured in by the incredible price action and the intoxicating story, were left holding the bag when the bubble inevitably deflated. Because their only reason for buying was the upward momentum, their only reason for selling was the downward momentum. This leads to the classic buy high, sell low pattern. When you own a story instead of a business, you have no anchor in a storm. Your emotions are completely tethered to the price of the stock, and you become a pawn in the market's manic-depressive mood swings. This is the opposite of a stock market strategy. It is a recipe for financial disaster, cloaked in the exciting garb of being part of the next big thing. The direct financial connection between owning businesses and owning speculative tickers is the difference between building wealth on a foundation of concrete versus a foundation of sand. The financial power of a wonderful business manifests itself directly on its balance sheet and in its cash flow statement, which in turn drives sustainable capital growth for its owners. Let's return to the See's Candies example. When you own a share of Berkshire Hathaway, you own a piece of See's. Every year, See's generates a certain amount of profit from its operations. After paying for its expenses and any necessary reinvestment back into the business, like opening a new store or buying a new chocolate-making machine, the leftover cash is called free cash flow, or owner's earnings. In a public company, this cash can be used in several ways. It can be paid out to shareholders as a dividend. It can be used to buy back the company's own stock, making each remaining share more valuable. Or, in the case of a conglomerate like Berkshire, it can be sent to the parent company to be reinvested in other opportunities. This is the engine of value creation. The cash generated by See's Candies directly funded the purchase of other fantastic businesses, which in turn generated more cash, creating a virtuous compounding cycle. The value of your investment is directly tied to this real, tangible stream of earnings. Now consider the financial reality of a pre-revenue story stock. It is not generating cash, it is burning it. Its owner's earnings are negative. To fund its operations and its dreams of future growth, it must constantly raise more money by selling new shares, which dilutes the ownership stake of existing shareholders, or by taking on debt. The only way for an investor to profit is for someone else to be willing to buy the stock from them at a higher price, a theory known as the greater fool theory. The value is not connected to any underlying economic reality. It is purely a function of market sentiment and speculation. When you own a portfolio of wonderful businesses, you are the beneficiary of their collective, growing earnings power. Your wealth increases because the underlying assets you own are becoming more valuable and productive each year. When you own a portfolio of story stocks, your wealth is dependent on the fickle and unpredictable psychology of the crowd. The former is a robust strategy for long-term wealth management. The latter is a roll of the dice. This leads us to the third great pillar of strategic inaction, a deep and abiding respect for the power of the compounding engine and a clear-eyed understanding of its greatest enemies: fees, taxes, and unnecessary interruptions. Albert Einstein is often apocryphally quoted as having said that compound interest is the eighth wonder of the world. While he probably didn't say it, the sentiment is absolutely true. Compounding is the process by which your investment returns themselves begin to generate their own returns. It is a snowball of wealth, starting small but growing at an ever-accelerating rate as it rolls downhill over time. The key to building a truly massive snowball is a long, uninterrupted hill. Every time you trade, you are stopping that snowball, chipping a piece off of it, and starting it rolling again from a slightly smaller size. To see this principle in action, look no further than Warren Buffett's most famous investment, Coca-Cola. In the aftermath of the Black Monday market crash of October 1987, the market was gripped by fear. Buffett, characteristically, was gripped by opportunity. He saw one of the world's most iconic and dominant businesses, Coca-Cola, trading at a reasonable price. Between 1988 and 1989, he invested over $1 billion to acquire a significant stake in the company. Many analysts at the time were skeptical. They thought Coke's growth days were over, that it was a mature, boring company. Buffett saw an unparalleled global distribution network, a brand that was synonymous with happiness in hundreds of languages, and a simple product that people would continue to consume year after year. He wasn't just buying the stock, he was buying a perpetual royalty on global thirst. And then, he did the most important thing: he held. He let the compounding engine run, without interruption. The result was staggering. Not only did the stock price appreciate dramatically over the next several decades, but the company continually increased its dividend. The initial dividend yield on Buffett's investment was handsome, but over time, as Coke raised its payout year after year, the yield on cost for Berkshire became astronomical. By the late 2010s, Berkshire was receiving more in annual dividends from Coca-Cola than its entire original investment cost. The dividends from Coke became a river of cash flowing into Omaha, which Buffett could then deploy into other investments, creating a second layer of compounding. The initial snowball of the Coke investment was now spawning its own smaller snowballs, all rolling downhill. This incredible story of capital growth would have been impossible if Buffett had tried to trade in and out of the stock. If he had sold after a big run-up in the 90s to lock in profits, or panic sold during the dot-com bust, or trimmed his position during the 2008 crisis, he would have interrupted the compounding process. He would have incurred massive capital gains taxes, and he would have forsaken the decades of ever-growing dividends that followed. His inactivity was the key that unlocked the full, explosive power of the compounding engine. The psychological force that works directly against our ability to harness compounding is a powerful cognitive bias known as hyperbolic discounting. This is our brain's built-in tendency to strongly prefer smaller, immediate rewards over larger, delayed rewards. It's the reason why so many people struggle to save for retirement, which feels abstract and distant, but have no problem splurging on an expensive dinner tonight, which provides immediate gratification. In investing, hyperbolic discounting is a killer. The quick, tangible profit from selling a stock that's up 20% provides a small, immediate dopamine hit. It feels good. It feels like you've won. The idea of holding that same stock for 30 years for a potential 10,000% gain is abstract, uncertain, and far away. Our brain discounts the value of that massive future reward so heavily that the small, certain reward today seems more appealing. We choose the cookie today over the entire bakery in 3 decades. Financial technology and brokerage platforms are masterfully designed to exploit this psychological weakness. The real-time profit and loss display that updates every second, the buy and sell buttons that are always just a click away, the notifications that alert you to a stock's big move. These are all tools of temptation. They are designed to shorten your time horizon, to make you focus on the immediate gratification of a trade rather than the long-term life-changing power of compounding. They turn investing into a video game where the goal is to rack up small wins, when the real game of wealth creation is about achieving a few massive multi-decade wins. To combat hyperbolic discounting, you must consciously and deliberately lengthen your time horizon. Stop thinking about what your portfolio will do this month or this year. Start thinking about what it will do this decade. When you evaluate a potential investment, ask yourself, is this a business I would be comfortable owning if the stock market shut down for the next 10 years? That single question forces you to ignore the short-term noise and focus on the long-term, durable characteristics of the business, the only things that truly matter for the compounding engine to work its magic. To put this into practice, you need to change the way you measure progress. The standard portfolio tracker, with its flashing green and red numbers, is designed to trigger your worst impulses. It's time to create a new dashboard, a do-nothing investor's dashboard, that focuses on the health of the underlying businesses, not the mood of the market. The first metric on your new dashboard should be owner's earnings growth. For each company you own, you should track, on an annual basis, the growth in its free cash flow per share. This is the true measure of the business's increasing intrinsic value. Is the company becoming more profitable over time? Is it generating more cash for its owners? This is the number that should guide your confidence, not the stock price. The second metric should be dividend growth rate. Even if you reinvest your dividends, tracking the rate at which your companies are increasing their payouts is a powerful indicator of their financial health and their commitment to rewarding shareholders. Watching your annual dividend income rise, year after year, provides a tangible and satisfying sense of progress that is completely independent of the stock market's daily gyrations. It makes doing nothing feel incredibly productive, as you are literally getting a raise each year just for being a patient owner. The third metric to track is return on invested capital, or return on equity. This measures how effectively the company's management is deploying capital to generate profits. A company that can consistently earn high returns on its capital is a compounding machine. A business that earns low returns is running on a treadmill. Monitoring this number tells you whether the business's moat is widening or shrinking. By shifting your focus from the output, the stock price, to the inputs, the business performance, you fundamentally change your relationship with your investments. You move from being a nervous spectator of a volatile game to being a confident owner of a portfolio of productive assets. The daily noise of the market fades into the background, and the long-term signal of business value becomes crystal clear. This mental model provides the emotional stability needed to let the compounding snowball roll, undisturbed, down its long and profitable hill. If the do-nothing dashboard is the path to enlightenment, then its antithesis is the triple tax of activity, the relentless, wealth-eroding grind of trading fees, bid-ask spreads, and taxes that plagues the active investor. This is the path where the 99% unknowingly surrender a huge portion of their potential returns to the financial intermediaries. Let's break down this triple tax. The first tax is the most obvious: trading fees and commissions. While many brokers now offer commission-free trading, they are not charities. They often make money on the bid-ask spread, the tiny difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. When you trade frequently, these tiny spreads add up to a significant cost over time, a hidden fee for your impatience. The second tax is the silent killer: capital gains taxes. When you hold an investment for more than a year, any profit you make upon selling is considered a long-term capital gain, which is taxed at a preferential rate. If you sell within a year, the profit is a short-term capital gain, which is taxed as ordinary income, at a much higher rate. The hyperactive trader is constantly realizing short-term gains, handing over a huge chunk of their profits to the government each year. The patient buy-and-hold investor defers all taxes for years or even decades. This allows 100% of their capital, including the money that would have been paid in taxes, to continue compounding on their behalf. It is an enormous, government-sanctioned advantage for the patient. The third tax is the opportunity cost of being out of the market. Active traders, in their attempts to time the market, often sell out and hold cash, waiting for a, quote, better entry point. The problem is that the market's best days often occur unexpectedly and in tight clusters. Missing just a handful of the best-performing days over a couple of decades can absolutely devastate your long-term returns. The patient, fully invested owner captures all of those days. They don't have to be smart enough to predict the future. They just have to be disciplined enough to stay in the game. Together, these three taxes create what financial author John Bogle called the tyranny of compounding costs. A small percentage siphoned off each year doesn't seem like much in the short term, but over an investing lifetime, it can consume more than half of your potential wealth. It is a slow, methodical transfer of money from your pocket to the pockets of your broker and the government, all facilitated by your own misguided activity. Let's run the numbers to see the devastating financial reality of this triple tax. We'll use our two investors again, Investor A, patient, and Investor B, active, each starting with $100,000 and earning a 10% pre-tax, pre-fee return. Investor A buys and holds for 30 years. Their only cost is a negligible index fund fee. They pay no capital gains tax until they sell at the very end, and it's all at the lower long-term rate. As we saw, their $100,000 grows to about $1.67 million. Now let's look at Investor B, who trades their entire portfolio once per year. Let's assume their trading costs, commissions and spreads, amount to just 0.5% of their portfolio value each year. And let's assume they realize all their gains as short-term, paying a 25% tax on their 10% annual profit. This means each year 2.5% of their portfolio is immediately siphoned off by taxes. The total annual drag from the triple tax of activity is 3%, 0.5% in fees, 2.5% in taxes. So their net return is not 10% but 7%. It seems close. But the power of compounding, or in this case, the destructive power of interrupting it, tells a different story. After 30 years, Investor B's $100,000, compounding at a net 7%, grows to just $761,000. Investor A has $1.67 million. Investor B has $761,000. That's a difference of over $900,000. The active investor ended up with less than half the wealth of the patient investor, even though they started with the same amount of money and had the same skill in picking investments. Their activity, their attempt to be clever, cost them nearly $1 million. This is the direct, brutal, and inescapable financial connection. Every click of the sell button is a vote to be poorer in the future. Strategic patience is not just a philosophy. It is a mathematical imperative for anyone serious about achieving significant capital growth. Now we arrive at the fourth pillar, a principle that provides the intellectual framework for all the others, the circle of competence. This is Buffett's idea that every investor must, with brutal honesty, define the boundaries of what they truly understand and then resolve to never stray beyond them. It is the ultimate filter for activity, because if you only invest in things you deeply comprehend, the noise and temptations of the broader market become irrelevant. The most powerful demonstration of this principle in Buffett's career was his famous refusal to participate in the technology stock bubble of the late 1990s. As the dot-com mania reached its zenith, Berkshire Hathaway's value languished. Tech stocks with no earnings and nonsensical business plans were doubling and tripling in value overnight, while Buffett's portfolio of old economy stocks like Coca-Cola, Gillette, and American Express seemed like relics from a bygone era. The financial media openly mocked him. A famous cover of Barron's magazine in 1999 featured a picture of a dejected-looking Buffett, with the headline, "What's wrong, Warren?" He was called a dinosaur, a man who, quote, didn't get it. The pressure to capitulate, to join the party, to buy some tech stocks to juice his performance was immense. Any normal fund manager would have caved, fearing they would lose all their clients. But Buffett's response was simple and unwavering. He admitted, freely and without shame, that he did not understand the technology companies. He couldn't confidently predict which ones would be the winners in 10 or 20 years. He couldn't value them with any degree of certainty. They were, in his words, outside his circle of competence, so he did nothing. He sat patiently with his portfolio of businesses that he did understand, businesses with predictable earnings and durable moats. And then, in March of 2000, the bubble burst. The Nasdaq index, a proxy for the tech sector, collapsed by nearly 80% over the next 2 years. Companies that had been worth billions were wiped out entirely. Fortunes were vaporized. The new paradigm was revealed to be the same old speculative mania. And Warren Buffett, the dinosaur, looked like a genius. His discipline had not only preserved Berkshire's capital during the crash, but it allowed him to emerge with a mountain of cash, ready to buy great assets at bargain prices when the dust settled. His inaction was not born of fear or stubbornness. It was born of a profound intellectual honesty. He knew the limits of his own knowledge, and that knowledge protected him from the madness of the crowd. The psychological principle at play here is a powerful defense against one of the most common cognitive traps in all of human endeavor: the Dunning-Kruger effect. This is the well-documented phenomenon where individuals with low ability at a task tend to overestimate their ability. In short, they are too incompetent to recognize their own incompetence. In the world of investing, the Dunning-Kruger effect is rampant. A novice investor, after a few lucky trades in a bull market, starts to believe they are a financial prodigy. They mistake luck for skill. This overconfidence leads them to believe they can be an expert in everything: biotechnology, enterprise software, cryptocurrency, emerging market debt. They feel they have an opinion on every stock and every sector, and they feel compelled to act on those opinions. They have an infinitely large but microscopically shallow circle of competence. Warren Buffett's approach is the complete opposite. It is an act of profound intellectual humility. He is arguably the greatest investor in history, yet he readily admits that 99% of businesses are simply too hard for him to understand. He doesn't try to have an opinion on everything. His genius lies not in knowing everything, but in knowing precisely what he doesn't know. The circle of competence is a tool for self-awareness. It forces you to confront the limits of your own expertise. By defining those limits, you create a powerful filter. When a new, exciting investment idea comes along, a hot IPO, a new cryptocurrency, a company in an industry you've never studied, you don't have to spend hours agonizing over whether to invest. You simply ask one question: is this inside my circle? If the answer is no, the decision is made for you. You ignore it and move on. This saves you from countless hours of wasted effort and, more importantly, from making catastrophic mistakes by venturing into territory you don't understand. It eliminates the emotional drivers of FOMO and greed, replacing them with a cool, rational process. You only swing at the pitches that are in your sweet spot. To make this concept practical, you can create a 3-bucket system for defining and managing your own circle of competence. This is a blueprint for organizing your investment universe and guiding your research efforts. The first bucket is the expert bucket. This is your core circle. It should contain only those industries or types of businesses where you have a deep, demonstrable, and sustainable edge. This edge might come from your professional career. If you're a software engineer, you likely have a much better understanding of enterprise software companies than the average person. It might come from a lifelong hobby or passion. Or it might come from having done over 100 hours of intense, focused research on a specific industry. You should be able to explain the competitive dynamics of this industry to a novice and answer tough questions about its future. This bucket should be very small. It might only contain 1 or 2 industries. This is where you have permission to make large, concentrated investments because your knowledge gives you a high degree of conviction. The second bucket is the competent bucket. These are industries that you understand reasonably well, but where you are not a true expert. You know the major players, you understand the basic business models, but you don't have the same granular, nuanced understanding as you do with your expert bucket. For most people, this bucket might include broad, easy-to-understand sectors like consumer staples or well-established technology platforms. You can invest in this bucket, but your positions should be smaller and perhaps more diversified, for example through a low-cost ETF. This acknowledges your competence, but respects your limitations. The third and largest bucket is the too hard pile. This is where everything else goes. New technologies you don't understand. Complex financial instruments. Companies in cyclical industries you haven't studied. Speculative ventures with no history of earnings. 95% of the investment opportunities pitched to you on any given day belong in this bucket. Your rule for the too hard pile is simple and absolute. You do not touch it. You do not research it. You do not have an opinion on it. You simply acknowledge that it is outside your circle, and you move on. This three-bucket system provides a clear, structured framework for financial discipline. It transforms the vast, overwhelming universe of stocks into a small, manageable set of potential opportunities, drastically reducing the temptation for unnecessary and ill-informed activity. The antithesis of the circle of competence investor is the style drifter, the investor who is a jack of all trades and a master of none. This is the 99% in its purest form. The style drifter has no core philosophy, no anchor of expertise. Their investment strategy is dictated entirely by whatever is popular at the moment. In 1999, they were a dot-com day trader, armed with a copy of The Motley Fool and a belief that eyeballs were more important than earnings. They bought stocks like Pets.com and Webvan, and they got wiped out when the bubble burst. In 2006, chastened by their tech losses, they became a real estate mogul. They watched house-flipping shows on TV, took out an interest-only loan, and bought 3 condos in Florida with no money down, convinced that real estate only ever goes up. They were wiped out again in the subprime mortgage crisis. In 2017, they reinvented themselves as a cryptocurrency visionary. They didn't understand blockchain technology, but they saw the price of Bitcoin going parabolic and felt the familiar pang of FOMO. They bought near the top of the bubble and were forced to sell in the subsequent crash. In 2021, they became a champion of meme stocks, joining the apes on Reddit to pile into GameStop and AMC, driven by a narrative of rebellion and easy money. The style drifter is a chameleon, constantly changing their colors to match the latest market fad. They are always chasing yesterday's winners, always arriving late to the party and often staying to do the dishes. Their portfolio is a chaotic museum of past bubbles. This path is not just financially ruinous, it's mentally and emotionally exhausting. Because they lack a core competency, they have no conviction. Their only guide is the fickle sentiment of the crowd, which leaves them vulnerable to every market panic and every speculative mania. They are perpetually active, but their activity is random and undisciplined, a series of unforced errors that grinds their capital down over time. The direct financial connection here is the concept of risk, specifically the risk of a permanent loss of capital. When you invest within your circle of competence, you can more accurately assess the true risks of a business. You understand the threats to its moat, the quality of its management, and the sustainability of its earnings. This allows you to make investments where the odds of a catastrophic permanent loss are very low. Even if the stock price goes down temporarily, your deep understanding of the business gives you the confidence to hold on or even buy more. When you venture outside your circle, you are flying blind. You cannot distinguish between a temporary problem and a terminal decline. You don't know what you don't know. Every investment becomes a gamble, a bet on factors you don't fully comprehend. This dramatically increases your probability of making a big mistake, an unforced error that results in a permanent impairment of your starting capital. A 10% loss requires an 11% gain to get back to even. A 50% loss requires a 100% gain. A series of large losses, driven by investments made outside your area of expertise, creates a financial hole that is almost impossible to climb out of. Compare the financial statements of Berkshire Hathaway, built on a foundation of in-the-circle investments like insurance, railroads, and utilities, with the portfolio of a speculative venture capital fund. Berkshire's earnings are relatively stable, predictable, and resilient. The venture fund's returns are a roller coaster of huge wins and total write-offs. While that model can work for specialized professionals, for the average retail investor, mimicking that level of speculative risk is a surefire path to ruin. Financial stability and consistent capital growth are the direct rewards of the discipline to stay within the lines you have drawn for yourself. This brings us to our fifth and final pillar, the one that ties everything together. It is not an analytical technique or a financial formula. It is a quality of character, the temperament of a master investor. You can have the best checklist, the deepest circle of competence, and the most profound understanding of compounding. But if you do not have the emotional fortitude to act on your knowledge in the face of fear and greed, all of it is worthless. Temperament is the execution layer of a successful stock market strategy. The ultimate anecdote for this is not just a single investment, but Warren Buffett's behavior during the darkest days of the 2008 financial crisis. In the fall of 2008, the global financial system was on the brink of collapse. Lehman Brothers had filed for bankruptcy. AIG, the world's largest insurer, had been bailed out. The stock market was in freefall. Fear was palpable. The prevailing sentiment was that we were entering a second Great Depression. People were pulling their money out of the stock market in a state of sheer panic, converting it to cash and hiding it under the mattress. It was the point of maximum pessimism. And what was Warren Buffett doing? He was deploying billions of dollars. He was not selling. He was buying with both hands. He invested $5 billion in Goldman Sachs and $3 billion in General Electric, two iconic American companies at the heart of the storm. He wasn't just buying their common stock, he was negotiating special deals for preferred stock with high dividend yields, using Berkshire's reputation as a source of stability to extract incredible terms. Then, in October of 2008, he did something even more powerful. He wrote an op-ed for the New York Times titled, "Buy American, I Am." He laid out a simple case. The American economy would, over the long term, recover and prosper. He stated that he was moving his personal cash reserves into stocks. He was publicly, clearly, and unequivocally telling the world to be greedy when others are fearful. This was not a market call about what would happen in the next month or the next year. It was a stunning display of emotional control. His mind was not clouded by the panic and fear that had paralyzed everyone else. He was able to calmly assess the long-term value of assets, while their short-term prices were being decimated by emotion. His actions in 2008 were the culmination of a lifetime of cultivating the right temperament. It was the ultimate act of strategic patience in reverse, the patience to wait for the perfect pitch, and then the courage to swing for the fences when it finally arrives. The psychological principles that Buffett had to overcome in that moment are the two most powerful and destructive emotions in the investing world: loss aversion and herd behavior. Loss aversion is the groundbreaking discovery by psychologists Daniel Kahneman and Amos Tversky that for the human brain, the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. Losing $1,000 feels as bad as winning $2,000 feels good. This asymmetry is a survival mechanism. Our ancestors were better off being paranoid about losing their food supply than they were being optimistic about finding a new one. In investing, however, loss aversion is a catastrophe. It causes us to feel the pain of a market downturn with extreme intensity. To make the pain stop, we sell our stocks, often near the bottom, crystallizing a temporary paper loss into a permanent real one. It also makes us unwilling to sell our winners, because that would mean realizing a gain which is less emotionally potent. This leads to the nonsensical outcome of portfolios filled with losing stocks that investors can't bear to part with. Herd behavior is our deep-seated instinct to follow the crowd. Safety in numbers was another crucial survival trait. When everyone else on the savannah started running, you ran with them. To stand still was to risk being eaten. In the market, this translates into a powerful urge to do what everyone else is doing. When the herd is buying enthusiastically during a bubble, we feel compelled to buy too, FOMO. When the herd is panic selling during a crash, we feel an almost irresistible urge to sell with them. The combination of loss aversion and herd behavior creates a perfect storm of irrationality. The intense pain of seeing our portfolio decline is magnified by the fear of being the only one holding on while everyone else is running for the exits. This is why markets overshoot to the upside and the downside. It's not about fundamentals, it's about mass psychology. Buffett's temperament is a form of counter-programming. He has trained his mind to treat fear in the market not as a threat, but as an opportunity. He knows that the point of maximum herd-driven fear is also the point of maximum financial opportunity. He has inverted the emotional response, a feat of financial discipline that is the true source of his legendary returns. How can one possibly cultivate such a temperament? It requires deliberate practice and the use of specific mental tools. Let's create a blueprint called the Stoic Investor's Journal, a set of practices based on ancient Stoic philosophy, which was designed to build emotional resilience in the face of chaos. The first practice is to rigorously differentiate between what you can and cannot control. You cannot control the economy, interest rates, geopolitical events, or the daily whims of the stock market. Wasting a single ounce of emotional energy on these things is futile. What can you control? Your research process, the price you are willing to pay for a business, your savings rate, and most importantly, your own reactions. The journal is a place to constantly remind yourself to focus your energy exclusively on this small circle of control. The second practice is negative visualization, or what the Stoics called premeditatio malorum, the premeditation of evils. Instead of just hoping for the best, you actively and regularly imagine the worst. You write in your journal, "What will I do if my portfolio drops 50% in the next 6 months? What is my plan? How will I react?" By mentally rehearsing for a market crash during times of calm, you inoculate yourself against panic when volatility actually strikes. It will still be unpleasant, but it will no longer be a shock. You will have a plan, and you will be prepared to execute it rationally. The third practice is to keep a detailed decision journal. For every investment decision you make, buy or sell, you write down the date, the thesis, the key variables, and how you were feeling at the time. You then review this journal periodically. This is not to see if you were right or wrong about the outcome, which can be due to luck, but to see if your trained process back was sound. This practice disconnects your ego from the outcome and forces you to focus on making good decisions with the information you have. It helps you learn from your mistakes and reinforces good habits. Over time, these three practices, like lifting weights for the mind, will build the emotional muscle required to stand apart from the herd, to remain calm in a crisis, and to execute your long-term strategy with unwavering financial discipline. The antithesis of the Stoic investor is the emotional roller coaster rider. This is the 99%, whose entire financial life is a symphony of exhilarating highs and gut-wrenching lows. At market tops, when their portfolio is flush with gains, they are euphoric. They feel like a genius. They check their account balance multiple times a day. They talk about their brilliant stock picks at dinner parties. Their confidence swells into overconfidence, and they take on more risk, convinced they can't lose. They are at the peak of Mount Stupid on the Dunning-Kruger curve. Then the market turns. The inevitable correction or bear market arrives. Their euphoria evaporates and is replaced by anxiety, then fear, then outright panic. The stocks they bragged about are now deep in the red. The pain of the losses, amplified by loss aversion, is excruciating. They watch the news, which is filled with apocalyptic headlines. They see everyone else selling. The herd instinct takes over. They can't take it anymore. They log into their account and liquidate their portfolio, often near the bottom of the trough, just to make the pain stop. They vow never to invest in the treacherous stock market again. They sit in cash, nursing their wounds, as the market quietly begins its recovery. Eventually, after the market has already risen significantly and the news has turned positive again, their greed overcomes their fear and they cautiously dip their toes back in, buying back into the market at much higher prices than where they sold. This cycle of buy high, sell low is the single greatest destroyer of wealth for the average person. It is not a failure of intelligence. Many very smart people fall into this trap. It is a failure of temperament. Their financial results are not a reflection of the performance of the businesses they invested in, but a reflection of their own uncontrolled emotional state. The direct financial connection is that temperament is the ultimate multiplier. It can multiply your returns to incredible heights, or it can multiply your losses to the point of ruin. All of the analytical work you do, finding a wonderful business, valuing it, understanding its moat, is the prerequisite. It gets you into the game. But your temperament determines whether you will actually win. Imagine your sound analysis leads you to a stock that is destined to compound at 15% per year for 20 years. If you have the temperament to buy it and hold it through all the ups and downs, your initial investment will grow more than 16-fold. Your analysis will be fully translated into realized financial wealth. Now imagine you have the exact same analysis, but you have a poor temperament. You buy the stock, but you get scared during the first major market correction and sell after a 30% decline. You've locked in a huge loss. You wait a year, see the stock has recovered and is making new highs, and you buy back in, chastened. Then another downturn comes, and you panic again. Over 20 years, the business itself performed spectacularly, but your personal return might be flat or even negative. Your poor temperament acted as a massive tax on your own good analysis. This is why Buffett says that investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. The essential quality is temperament. It is the final, crucial link in the chain of wealth creation. It is what transforms a sound stock market strategy on paper into tangible, life-altering capital growth in your bank account. A solid temperament ensures you are there to receive the full rewards that the patient, business-like owner of great enterprises is entitled to. You have made it through a deep and intensive deconstruction of one of the most powerful financial principles in the world. You've invested your time, and in return, you have acquired a powerful mental tool. You now understand, on a fundamental level, that in the world of investing, activity is often the enemy of returns. You see that strategic patience is not passivity, it is a weapon. You have been given the blueprint to overcome your own worst instincts, the action bias, the herd behavior, the pull of hyperbolic discounting, and to replace them with the disciplined business owner mindset that has made Warren Buffett a legend. You are now armed to protect your capital from the corrosive effects of excessive fees and taxes, and to let the magnificent engine of compounding do its work for you. But mastering the art of doing nothing is only one half of a complete system. The journey to becoming a true architect of your wealth is not just about defense. Patience is the shield. It protects you from making mistakes, it preserves your capital, and it allows your wonderful businesses to grow uninterrupted. But a shield alone does not win the war. The other half of the equation, the principle that works in perfect harmony with patience, is the sword. The ability to recognize those rare, once-in-a-decade opportunities and to act with ferocious, concentrated, and decisive boldness. Buffett's career is a study in this duality. Long periods of apparent inactivity, punctuated by moments of immense, focused action, like his investments during the 2008 crisis. You have now mastered the shield. You understand the profound power of waiting. But what about the sword? What are the mental models that allow you to identify the perfect pitch when it finally crosses the plate? How do you build the courage to swing with everything you have when the rest of the world is paralyzed by fear? The video that is now appearing on your screen is designed to be the missing link. It is the next piece of the map. It bridges the gap between the strategic patience you have just learned and the decisive action required to build extraordinary wealth. Most people will stop here, content with having learned how to play defense. But the serious student, the future master of their own financial destiny, understands that the system is incomplete. The decision to click is not just a decision to watch another video. It is a commitment to completing your mental arsenal. It is the choice to move from being a passive beneficiary of the market to becoming an active architect of your fortune. The link that connects everything awaits.